Okay, good afternoon, everybody, or good morning or late evening, depending on your time zone, and welcome to this webinar on Bank of Finland Institute for Emerging Economies' latest Russia forecast. As is customary, we are again publishing our biannual Russia forecast covering years 24 to 26. Senior economist Sinikka Parviainen will first present the forecast, then I will talk about Russia's trade with China. It was very appropriate since this is the 75th anniversary of the founding of the People's Republic of China, for those who don't know. You are all very much encouraged to post questions to the chat while we are presenting. We will have time for questions and answers after both of the presentations. The presentations will be recorded, and you will receive a link to the recordings later after the seminar has ended. But now, without further ado, I would like to invite my colleague Sinikka Parviainen to present the forecast. Sinikka, please.
Thank you, Ika, and welcome from my part as well. So, as promised, I will first talk you through our forecast and then present some recent developments in the Russian economy that are behind our forecast. But before we go further, let's first talk about our forecast assumptions. Firstly, we are not making any explicit assumptions on the war itself, but we assume that the sanctions pressure will remain at the current level as it is now. Then secondly, we assume that there won't be any massive shocks to global commodity markets. And based on the Brent crude actual price of this year and oil price futures, we expect the oil price to remain at about $82 per barrel this year, and then fall to about 71 to 72 barrels in the next few years. And then also related to our first assumption, the discount to Russian euros oil will remain roughly at the current level of about $12 to the barrel. Then third assumption is related to Russian economic policies. We assume that war spending, military spending will remain a priority if it comes at odds with other previously well-established goals such as price stability or fiscal stabilization. Then fourth, we assume that the nominal ruble rate would remain at the current level, roughly at the current level of about 92 against the US dollar. And as you might remember, the ruble is no longer internationally exchangeable or free-floating currency. Now, as a last warning, our forecast is still subject to very high uncertainty due to lack of transparency, and especially due to the fact that we don't have access to all the crucial statistics on the Russian economy, such as foreign trade volumes or detailed spending on detailed state spending. But now, you might remember that in the spring, we forecasted that the Russian economic growth would reach about 2% this year, but now we're upgrading our forecast to 3.5%. And the main reason is that the first part of the year has been showing stronger growth than expected, and even with a significant slowdown in the second half of the year, economic growth would go easily above 3%. And in our last forecast, we clearly underestimated the continued fast expansion of private demand and in fixed investments, as well as the tightening effect of sanctions on Russian imports. Now, if we look at the different components of our forecasting on the demand side, Private consumption has clearly been given the largest contribution to growth and will continue to fuel economic growth this year, but at a smaller growth rate in the next few years. We have seen that wage increases have been very sizable also this year, and we expect these wage increases to remain above inflation levels, especially because the shortage of labor in the Russian economy is forcing companies to compete for especially those high-skilled workers. At the same time, strong growth in household loans is expected to decelerate due to higher interest rates and government curbs on subsidized loans and the tightening of the central bank's macroprudential policy. Then public consumption will show strong growth this year, close to the levels we saw in 2023, and continue to be driven by the war expenses to a large extent, with possibly some deceleration in 2026. Gross capital formation and investment in fixed assets have been the fastest growing demand components in Russian GDP. And we expect the growth to remain strong also this year and at a slower pace in the next 2 years. War-related industries or those tied to the war effort will continue to fuel demand, and private companies who are involved in these supply chains will continue to invest their profits, which have been accumulated over the last, you could say, very profitable years. But will also continue to receive state support through preferential loans and state guarantees. At the same time, we clearly see that firms are faced with high wage burden, all firms, and there will be a higher tax burden for most of the companies starting from next year. Those private firms who are facing market rates, who are not receiving these preferential loans, will have less incentive to invest due to high interest rate environment that is expected to persist over the forecast horizon. Now we look at foreign trade volumes. Export volumes we expect to remain roughly at the current level as they are today, and no large drops in the demand for Russian main export products is expected. But also the probability that Russia would find new large export destinations is small due to the threat of secondary sanctions. We have seen this year that imports have declined due to the weaker ruble and stronger, let's say, tightening secondary sanctions on Russia's trading partners that have caused problems with payments and logistics. And we expect this lower level of imports to persist in 25 and 26, which will effectively mean that we expect a positive contribution to GDP for net exports this year and a negligible or zero effect in the next 2 years. Now, what do we see from the recent statistics on the Russian economy? As I already mentioned, the beginning of this year, Russian real GDP showed strong growth, mainly driven by private demand, unabated growth in loans, and the state's expansive fiscal policies. But now in the second quarter of the year, growth has decelerated, and the quarter-on-quarter seasonally adjusted growth has halved from the first quarter. We see the deceleration has been wide-ranging, but it's increasingly attributed to supply-side constraints in the Russian economy. And one sign of these constraints is the historically high capacity utilization rate. This is actually not an entirely new problem in the Russian economy, and the issue of capacity constraints was much discussed already during the fast recovery after the COVID-19 lockdowns. But now the situation seems to have escalated further, and we have seen capacity utilization rates have increased to record highs in nearly all the major sectors in the Russian economy. Now, these survey results imply that the fastly growing investments in fixed assets that we saw last year have not been directed at production enhancing capacities, which would usually be the logical result. An equally binding constraint, or even more so, is the shortage of labor that I already mentioned, and this problem has its roots in the adverse demographic development over the last 3 decades in Russia. But now the current conditions that have emerged or have been built in Russia since Russia's full-scale war against Ukraine have made the situation even worse. Unemployment rate is beating records every month and currently stands at about 2.4%. Nominal wage increases have been about 18% on average over the first 6 months of the year. And according to the central bank survey here, shortage of labor is most acute in the production of capital goods and consumer products, and are at record levels in all the sectors since 2020. Now, as these constraints on the supply side coincide with a strongly growing demand, it has naturally led to accelerating inflation. And declining imports have not been able to alleviate this burst in demand. So as inflation has accelerated from last year, starting from last year, the Central Bank of Russia has raised its key rate strongly since the summer of 2023, quite fairly fast to double-digit levels. But this has not had the desired effect. And now 2 weeks ago, the key rate was raised to a very high level of 19%, which is close to the levels at the outset of Russia's invasion of Ukraine. And but as you can see, the inflation levels themselves are not as staggeringly high as back then. But the central bank is seeing that price stability is harder to achieve under the current conditions, and this is due to large government spending or unabated government spending that is undermining the bank's efforts, and weak responsiveness of the loan markets. Some cooling off has been achieved in household loans, retail lending, with tightening macroprudential policies, but the central banks have been less successful in curbing corporate lending that is tied to state demand. So now this situation requires, or will require, the central bank to keep its key rate higher for longer. And the central bank is predicting that in 2025, the key rate would be upheld between 14 to 16%, and at over 10% still in 2026. But I have to mention here that these key rate projections were outlined before the recent budget plans were published for the next 2 years, and I will talk about them a bit later in the presentation. Now we are seeing some signs of slowdown also in industrial production, and especially the manufacturing sector that has been a strong driver of growth has declined to a lower level in the recent months, with especially driven by these war-related industries. Now the decline in the production levels seems to have come to a halt in August, but still in annual growth terms, the industrial production continued to slow down also according to the statistics from August. I think today a purchasing managers index for manufacturing was published, and it shows a move to negative territory for the first time since April 2022, which also is another sign of worsening conditions for manufacturing companies. Interestingly, the extractive sector that has not really yet recovered from the 2022 drop and was declining over the summer has shown a small improvement also in August. Now it still remains to be seen if these levels of production will persist. Now, as you can see, business sentiments overall have become less optimistic, and they have dropped from the, you could say, very, very high levels from the beginning of the year. At the same time, company expectations have improved somewhat, according to the Central Bank of Russia survey data. And the extractive sectors are showing some improvements in their sentiments, which probably coincides with the improvement in production levels that was seen on the graph on your left. Now, if we look at the consumer side, growth in retail and services has decelerated over the last months since the first quarter of the year. And we know that growth in real wages in Russia has decelerated slightly over the summer to reach about 6% in June. We see that consumer confidence has fallen to a lower level, and after it reached these record highs in the beginning of the year. Now, state spending has been, you could say, one of the stronger drivers of growth since Russia's war against Ukraine. And this week, a revised budget plan for the next 3 years, a draft budget plan for next year, and a plan for 26 and 27 was submitted to the Duma. And this also entailed some information on how budget spending has developed over this year, because Russia doesn't publish these actual spending numbers. We see from this new information that the planned federal budget deficit for this year would widen to about 1.7% of GDP. And it has increased slightly from the June. And say a plan that was accepted in the Duma in June, which is still less a smaller deficit than we saw in 2023. For the whole budget system, for the consolidated budget, the budget deficit for this year would reach about 2% of GDP, which is about the same level as we saw in 2023. Now, the big news in this budget plan was the record high increase into defense spending that would reach about 6.2% of GDP, which is in stark contrast to the previous plan for 2023, with actually 2025, which actually included strong cuts to military expenditure. In this budget plan, revenues are projected to increase faster than expenses, so it's going to be a stabilizing budget, and the government is stating that a larger share of the revenues, about 2/3, will be from non-oil and gas revenue. So there will be less dependence on oil and gas. And we know that there's changes to the tax code were accepted already previously, especially corporate tax level was hiked, which would bring altogether 1.3% of GDP to the whole budget system. At the same time, we know that, for example, in this new plan, communal services for households, they will be increased at a much faster rate that was in the previous plan. So there will be an increase about 12% into these tariffs as well. And oil and gas revenues are expected to decrease in this budget, but only slightly. So as I said, this as revenues would be increasing at a faster pace than expenses in this budget plan. The budget deficit in the federal budget is planned to decrease to a very low level of 0.5% of GDP and 0.8% for the consolidated budget, which would be you could say a clear improvement from the last year's deficits. And the deficits are planned to be covered with domestic debt, domestic bonds, state bonds. At the same time, we see that the assumptions behind this forecast could be deemed slightly optimistic. The budget plan for next year would assume GDP growth of 2.5% and 2.6% for 2026, which is clearly above most of the forecast for the Russian economy at the moment. Also, the export price of oil is based on the current oil futures we see, it seems to be slightly optimistic. Now, just to conclude, I will talk about risks to the forecast, which are still plenty. The first obvious risk is the war, the development in the war, and how Russia responds to these changes, which might not be always the one that is expected. The second risk is fiscal policy that I just talked about, and this risk has materialized before, and could be related to our risk number one as well. Russia could decide to spend even more than it's planning now. The third risk is you could say the traditional one for the Russian economy. And we know, of course, that commodity markets are very vulnerable to large geopolitical shifts and changes in major economies. And for example, we know that recently the oil prices have declined in part due to worries on sluggish demand from China. I think China was a good bridge to the next presentation, so I will stop mine here, and really looking forward to your comments and questions. Thank you so much.
Thank you, Sinikka. And as was mentioned, the topic of my presentation will be Russia's trade with China. And I will argue basically that China has become very, very important, or even the most important trading partner for Russia, at least on the import side, potentially also on the export side. After the invasion of Ukraine and the consequent sanctions against Russia, the geographical structure of Russia's foreign trade has changed drastically. First of all, Russia does not publish detailed data on its foreign trade anymore, so we have to rely on partner countries' data. So here, for example, in this chart, we have collected data from the EU, US, UK, China, Japan, Korea, Taiwan, Kazakhstan, Turkey, so on. First here, looking at those countries' exports to China, so the value of their exports to China. We can see big drop in the EU exports to China after the February 22 invasion. We can also observe that the EU as an aggregate continues to export to Russia. So many things we export are not under sanctions. At the same time, we can observe that Chinese exports to Russia have risen, and in recent months they have been between 20 and 25% higher than they were before the invasion. We can discuss later the sort of possible sanctions evasion, say via Turkey or Central Asian countries. But I do think it's important to notice that in terms of overall value of exports to Russia, which means to say Russian imports, it is China that really matters in terms of overall aggregates. It's perhaps interesting that for the aggregate, these countries that we have collected here, which before the invasion were Russia's most important trading partners, exports to Russia or Russia's imports have been sort of more or less stable since the beginning of 23. So that might mean that Russia has looked for other trading partners, or then the weakness of the ruble, problems with the payments, and so on, have constrained Russia's ability to import goods from abroad. The one further thing is perhaps worth noting, and it is that Russia's and China's foreign trade, or their bilateral trade, is very asymmetric. So China makes up approximately 1/2 or slightly less than 1/2 of Russia's total imports, whereas Russia makes up 3% of China's exports. So even though obviously China trades with Russia and it's by all accounts profitable for Chinese companies, then the degree of dependence is very asymmetrical. Then I'll briefly turn to the structure of trade between Russia and China. What kind of things does China export to Russia? What kind of things does Russia import from China? Well, the short answer is that everything. So, I mean, China produces so much for the global market that for most countries, Russia actually imports many things in very different categories from China. And like Finland, like many other countries in the global economy, Russia imports a lot of metals, machinery, electrical equipment, and so on. It's worth noting that it's especially vehicles where the growth has been the fastest. So in the first 8 months of this year, compared to the first 8 months of 21, which of course still was partially COVID era, especially in China, the value of Chinese vehicle exports to Russia is up by almost 450%. Again, this increase is fairly widespread, sort of across many different vehicle types, but it is especially pronounced in passenger cars. Currently, Russian market has 14 different car brands. 3 of them are Russian, 11 of them are Chinese. So in essence, what has happened since the most or all foreign car manufacturers have withdrawn from the Russian market, the factories are either idle or producing at fairly low capacity. Imports from China have filled the void. The Russian sort of car fleet is becoming more and more Chinese. Again, you can see that perhaps in recent months there has been some stabilization of overall Chinese exports to Russia, partly because of weaker ruble, but also we have read many media reports both from China and Russia about the problems in payments between Russia and China, as Chinese banks many Chinese banks are afraid of secondary sanctions from the US Treasury and are either very cautious or completely unwilling to deal with Russian customers. This, of course, makes trading more difficult and, in any case, at least more costly. So we will see if this trend continues in the coming months and quarters. Then I already mentioned the possibility of some goods reaching Russia, some sanctioned goods reaching Russia via third countries. So here, for example, we have the exports from China on the left-hand side to Russia, on the right-hand side to Kazakhstan, Kyrgyzstan, and Uzbekistan. Of the 35 product lines in HS chapters 48 and 84 and 85 that are in the so-called high priority items of the list of the EU. Again, we can see that, for example, in the first 7 months of this year, the Chinese exports in these categories were up 71% from the corresponding period in 21. This would imply that this story about sanctions avoidance, or at least trade diversion, is partially true. On the right-hand side, we can see that first of all, direct Chinese exports to Russia in these items are much larger than Chinese exports of these goods to Central Asian countries. But if you really squint your eyes, you can see that exports to these countries have also increased. And if we sort of change the scale of the right-hand side chart, we can see that basically the exports to all of these countries have increased, and exports to Kazakhstan have really taken off, especially in 23. Although it has to be said that we have seen spikes in Chinese exports to Kazakhstan already before. So it might be that at least partially this has nothing to do with sanctions and sanctions avoidance. But it's clear that Russia is able to access at least some of the goods that are on the EU, US, and so on sanctions list via China. Might be partially sanctions avoidance, so EU goods go to Russia via China, or it can be just trade diversion that Chinese producers have replaced EU producers in the Russian market in these goods. Then I will turn to Russia's exports, and obviously the most important export goods for Russia for literally decades have been hydrocarbons, so crude oil products, and natural gas. Here we have data collected from the Center for Research on Energy and Clean Air, looking at Russia's export of hydrocarbons to different geographical areas from the beginning of 22. This is a 30-day average. The sort of brownish red area is China, and then the yellowish area is India. You can see that before the invasion, Russia didn't export crude oil to India. But this has changed, and now, depending on the month, it's either India or China that is the most important destination for Russian crude oil. And of course, we have to remind ourselves that the whole idea and the thinking behind the G7 oil price cap was that the physical flow of Russian crude oil to the global markets would continue, but we would be able to constrain the amount of money Russia gets for each barrel of crude oil. It might be, well, the first aim, so the continuation of physical flow of Russian crude oil, certainly has been achieved. The second goal of constraining Russia's export and tax revenue from crude oil, we have been less and less successful after this, at least after the summer of 23, in achieving that. Now, it might be that both the actions of US Treasury in sanctioning various operators in tankers, insurance companies, and so on, and then the generally lower level of oil prices are now working towards sort of achieving that goal. But we have to admit that the adaptation of Russia and other market participants to the oil price cap was more successful than we thought originally. Then in energy, and especially in crude oil and coal, then actually Russia is important for China. So here, the value of crude oil imports from different countries, and the imports to China, we can see that Russia is and has been for quite some time the most important provider of crude oil for China. It was important already before. You have to remember that. But especially during the past year and a half, its importance has grown. Saudi Arabia remains important. There are some anomalies there, like Malaysia, where apparently the Chinese imports of Malaysian crude oil are actually higher than the whole crude oil output of Malaysia. So most likely this is just mislabeled Iranian oil. But clearly, Russia is important. Russian crude oil is important for China. We can also observe that for a long time, China has been very successful in sort of balancing its portfolio of different providers of crude oil. And actually this applies to many other commodities as well. This is then Chinese imports from Russia in terms of volumes. So we have crude oil, coal, LNG, and then oil products. You can see again that the Chinese imports of crude oil were fairly high already in 2018-19. They are now perhaps 30% higher than they were before the invasion. But it is especially coal where the growth in imports has been quite drastic. And there have been periods where Russian coal has been between 40 and 50% of Chinese coal imports. This is quite something. And of course, given the importance of coal in China's energy mix, this means that China is in some sense dependent on Russian coal. Then to wrap up and allow room for discussion, questions and comments, if we look at Chinese investment into Russia, and here we have the foreign direct investment numbers collected by China Global Investment Tracker. Basically, what they do is they look through news reports and try to take into account all the investment deals, whether it's greenfield or M&A, that are larger than $1 million. First of all, we can see that the Chinese investment abroad collapsed after 2017. We do remember that there was a lot of money, big current account surpluses, and Chinese companies were encouraged to go abroad. This has changed. We can also see that for a long time, FDI into Europe has been the biggest, Europe has been the single biggest recipient of Chinese FDI, although there are years when perhaps also the US has played that role. There have been investments into Russia, They have never been as big as investments into US, East Asia, or Europe. And after 2022, we only have literally a handful of deals where Chinese companies have invested in Russia, at least according to this statistics. I should note that also Chinese official FDI numbers do tell a similar story. So to conclude, China is now by far the most important trading partner for Russia, the most important source of imported goods. And then this relationship and dependency is, as I noted, very asymmetrical. So China is much less dependent on its trade with Russia than the other way around. China has increased its exports in all categories, but the increase has been especially large in vehicles as Russia's own production has collapsed. But as was noted, Russia is importing many things from China, as we all do. When trying to look into the Chinese exports of sanctioned goods, there has been a clear increase both in direct exports to Russia and also in Chinese exports to Central Asia. Now, it might be that some of these goods previously went first to Russia and then to Central Asia, and now the logistics between China and Central Asian countries have improved, so there's more direct bilateral trade. But I guess it is fair to think that at least some of these goods will continue from Central Asian countries to Russia. Then on looking at Russia's export of commodities, especially energy commodities, China is a very important customer. And vice versa, also for China, Russia is important, especially in crude oil and coal. And then finally, the Chinese companies have been very cautious in their investment in Russia, and this was true already before 2022.